Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 254th VideoCast podcast for the week ending August 29th, 2024. We'll kick it off with some pictures and some family stuff, then we'll get right down to it. Last week's podcast was absolutely incredible with special guest Brendan Ahern, who runs the K-Web China Internet ETF. If you didn't get a chance to listen to it over the weekend, I would suggest you spend the time and listen to it, go on a long walk, go on a long bike ride. It was awesome. This week, I'm going to try to cut that in more than half and do a short one because I know everyone wants to get away for the holidays, but we do have a lot of important stuff to cover, so we're going to get right down to it. First and foremost, want to let everyone know I'm going to need a new admin that does all the posts on the blog every day, the indicator of the day, the where is money flowing. On Thursdays, you'd be very busy doing all the syndication of the article of the week onto Substack and Talk Markets and Seeking Alpha. You basically copy and paste it onto LinkedIn. And then the earnings reports by sector, we teach you how to do that. Basically, once you figure it all out, it's literally 5 to 7 hours a week. You need to be around midday to do some of the live postings between 10 a.m. and 2 p.m. So probably ideal for maybe a stay-at-home mom or someone younger who doesn't have a day job. And I think you'll find it enjoyable and long-lasting. The people that I've had in that position have lasted a long time, and they either go back to college or they go to a full-time job or whatever it happens to be. But we're going to move on that. So if you're interested, and for all of you who applied for the video editor job, first off, we want to welcome Steve Frampton. And if you applied for that job and didn't get it, then you will have significantly more weight if you apply for this gig. And you can just click on contact, enter your information. We'll get back to you over the weekend and get you started as early as Tuesday. We have this pretty automated now. You watch a few videos, you'll know exactly what to do, and off to the races. So, this is the boys. We got out in New Jersey. Kevin Mon had us out to his club, Rockaway in Denville, New Jersey, country club, which was awesome. And you probably recognize these guys. That's Kevin Mon. He's on everything, Fox Business, CNBC. Lou Bassanese, regular on Varney and Cavuto. Mark Tepper, regular on Mornings with Maria on Fox Business and Varney. And then me. So that was just a tremendous amount of fun. This is at Yahoo Finance. That's the whole control booth where all the magic happens on Tuesday behind the scenes. And that's that. Then we had over the weekend, the girls got awards for High Point for swimming, High Points for their age group for their team. And that's Annabelle receiving her medal. And that is an out of order picture, but that's Caitlin and I having date night while the girls were at sleepaway camp in Pennsylvania. So that was fun. We don't get to do that enough. There was Yahoo Finance offices, and that was me walking the streets at night to get some exercise. Channel checking, that's Canada Goose on Fifth Avenue. And I'm taking that picture, I think, from the Van store. I had a great conversation with guy in the Van store about how well the Avenue sneaker is doing because like one of these top skateboarders uses it, so every skateboarder has to have it. It's kind of like Tony Hawk back in my day. And the new school, he can't even keep on the shelf. All the kids are coming in, all the parents are coming in to buy it for their kids for school, so that was really good to see. And then that's also at Yahoo. That's the High Point. Okay, and then today, Kelly O'Grady got to be on the Clayman Countdown Fox Business. That's a picture. I also had a picture on Twitter with Brad Smith, the exact same picture at Yahoo. So you can look that up on my Twitter feed. I don't know where that got lost in the fold. But first thing, I want to bring on the Cavuto Coast to Coast segment from Monday. It was actually two segments, one in the beginning, one at the end of the show. And it really covers our whole perspective for the next few months. So I want to listen in here.
breakout record in the opening hour and a half or so. It looks like we were going to be off to the races. Then all of a sudden, after reaching that record, we have since come down, barely changed on the day. What to make of that, of course, this is a time where a lot of traders are trying to reassess what happens next month with the Federal Reserve. Most everyone agrees that a rate cut is coming. What we don't know is how big a rate cut it will be. Kindly enough, Thomas Hayes to answer some of those questions. Brilliant young man, the chairman and the managing member, Great Hill Capital. Thomas, great to see you. I'm going to get a twofer with you today, so I'm excited. Let me ask you a little bit about how the market is digesting all of this news on the Fed, then, of course, the attention on Nvidia. We've got a lot going on this week.
Yeah, I think Friday at Jackson Hole, that confirmed a regime change. So with the Fed cutting, different groups in the stock market are going to be able to outperform. For example, small caps, the first 12 months after the first cut, they tend to outperform large caps by 11 full percentage points. Why? Because most small caps have leverage on their balance sheet, and when they can refinance at lower rates, they have a higher propensity to survive.
But they outperform by that much? How far does this go back?
This goes back to 1955.
Get out of town.
Yeah, it's wild.
Right.
And then on the
But haven't they had there was this transition going on?
Yeah.
So that it's going to go even beyond that.
Yeah, it started in July, and then it cooled off with the yen carry trade unwind for 24 hours. But it's interesting. The Fed said they're going to cut. So now Bank of Japan, what did they say? Now we can start to raise again. So you're going to see groups like small caps start to outperform. You're going to see international stocks start to outperform as the yen carry trade unwinds. The dollar weakening, rates coming down. Dividend payers start to outperform. So
what if the yen becomes the world's premier currency in this interim? How does that affect us? Wouldn't that be good for U.S. multinationals and their stocks in an environment like that?
Yes, U.S. multinationals will do well. It won't become the premier currency because their demographics don't support it, but it could strengthen relative to the dollar in the near term. We saw a similar situation in the early 2000s. If you remember, emerging markets were out, small caps were out, and then all of a sudden, from 2002 to 2007, you had one of the biggest rallies in history in emerging markets, in small caps, actually in value over growth. We had that concentration of tech going into that.
Right.
So I don't think tech is going to crash. I just think they're going to underperform because their earnings growth is decelerating from 30% this year to 18% next year. While the unmagnificent 493, they went from...
I like that. We have the Magnificent 7 and the unmagnificent, but they could be a little bit more magnificent now, right?
That's right. They're going from negative earnings growth. They just inflected to positive earnings growth. That is going to continue into 2025. So you can see with the weighting of tech, the indices are a little bit more subdued, but under the surface, there's a tremendous amount of money to be made in individual high-quality companies that are temporarily marked down.
Now, Nvidia, I think, reports Wednesday at the closing bell. And normally it's been a good trade to buy up ahead of an earnings announcement because it does very well right afterwards. I don't know how long that's held, to be honest. What do you expect this time?
I'll tell you, it's priced for perfection.
Yeah.
I think that they'll probably have good earnings, but the analysts are saying they got to beat revenue by $2 billion in order to move the needle. They've got to raise guidance by at least $2 billion. People are a little worried about the Blackwell delay, the new chip delay by 3 months. They want some guidance on that. But if you step back, I'm old school. I was always taught if you buy high quality assets when they're at reasonable valuations, good things tend to happen over time. This is trading at 29 times sales, $3.2 trillion valuation. Just to put that in perspective, our entire GDP is $25 trillion. Nvidia is 3.2.
So the upside potential in your eyes is limited here.
It's a little more
But what
limited.
about those who are existing Nvidia shareholders and have been riding this wave? Would you tell them to cash out, parse some of the shares?
Look, you will have time. Okay, so even if the report came in poorly, I don't know that it will, because we did see from the hyperscalers a lot of demand for spend.
Right.
I think what we're also seeing is margins are declining for the Magnificent Seven because of all of that spend. And at some point, like you remember Mark Zuckerberg with Meta, he said, I'm going to invest all this money in the metaverse. And then all of a sudden the shareholders said, we don't like that. And they took the stock down below $100. All of a sudden he said, you know what? I'm no longer going to invest that much in the metaverse, and the stock went back up. I think we're seeing a similar situation.
But he's actually one of the star performers of the metaverse.
Yeah, because he stopped all the spend on Meta. And I think investors are starting to ask, where's the return on investment for all this AI spend on Nvidia chips? And that's not a today's story, but as margins decelerate a couple quarters out, and I think the market's starting to see that, we could see a situation where the spend for Nvidia chips slows down and more competition comes up for the GPU chips from other companies.
Real quickly on the political race and how that's factoring in, normally gets to be a big issue after Labor Day in October.
Yeah.
We were getting a lot of machinations much earlier this year. I don't know if that has anything to do with the race, but what do you think?
Okay. Election year seasonality, going back to World War II, we see strength on average through early to mid-September. This year, that happens to coincide with the first cut, which historically, it's sell the first cut. So you have the election year seasonality, which gets a little choppy in late September, early October, and sell the first cut. So we think we'll cruise along here for a few weeks. Maybe we'll get to new highs across the board, and then get a little conservative before the election. I think year-end rally after the election.
Hang on to that brilliant thought, because I do want to pursue this election thing with you, because there's a raging debate going, who takes credit when the markets go up, who gets it when it goes down. More with Thomas Hayes in just a second. We were mentioning this presidential race and where it sorts out. We're getting indications right. All right, to hear Donald Trump tell it, markets go up, it's because of him. When they go down, it's because of the other guy or gal. Bottom line is, it's not quite that black and white, but back with Thomas Hayes on what factors the markets could be looking for. And you were raising something interesting during the break. It's not about who's at the top when it comes to the White House, but the makeup of Washington. Explain.
Empirically, if you look back throughout history, the stock market performs best when one party does not have the executive, the Senate, and the House. So what the markets really want to see is gridlock, and what that is a check on power. In simple terms, the less the politicians can do, the better it is for the markets. Let the markets be free, let business be free, and that will power things through, and the stock market performs best in those environments.
Now, I was looking into a little bit of the history on this. It's ideal if it's a Democrat in the White House and the House and or Senate are under Republican control, or both. It has happened. That was an ideal environment under Bill Clinton.
Yep.
How do you see it going now, and what would be the ideal environment now?
Well, that is true empirically. Some of that was demographically based. But if I was going to write a book on how to cause a Great Depression, the first chapter would be entitled, Start Taxing Unrealized Capital Gains. I mean, you can't make this up. Who thinks of this, that you would run on that platform? So the number one thing that we want to...
You're talking about Kamala Harris's plan.
Kamala Harris's plan.
Right.
Like, you can't imagine. You have one candidate that's pro-business. You have one candidate that's pro-government. Just taking aside the politics out of it, just from an economic standpoint, the platforms of what's going to be better for employment, what's going to be better for the economy. I mean, if you started taxing unrealized capital gains and people grasping for liquidity, it would be the quickest way to a Great Depression.
Normally, you tax your capital gains once the trade is commenced and all of that. But if this would be, obviously, people would be less inclined to get the markets. Now, Democrats could come back and say, well, that's not our cup of tea. We don't like the markets. But it's interesting you chose that issue rather than her wanting to raise the corporate tax rate to 28%.
Well, we've been there.
We've been there is right.
We've been there, the corporate tax.
And a lot higher. We were at 35.
Look, I mean, let's be fair. Some people like to borrow and spend politicians. Some people like to tax and spend politicians. The key is all politicians like to spend. That's how they retain their power. So that's a risk. But in terms of the market, in terms of corporate tax rates, it still has to get through Congress. So they've got to have a grand slam, Senate, House, and executive branch to push that through. So the market's kind of like, okay, 28%, you're not going to get it. Even if you're elected, as long as there are checks and balances, the markets and the economy will be okay.
What do you think? I've talked to a lot of people from the markets, Tom, who say Donald Trump is far more market-friendly, issues-wise, than he was as a president than Joe Biden or what we hear out of Kamala Harris. But their big pause is he's crazy. And he'll do crazy things, and that will defeat all the other good stuff he's doing. And that gives them their trepidation. Is that justified?
Okay, this is hysterical. So when Trump was elected, everyone said, energy stocks are going to do incredible, China stocks are going to collapse, and solar stocks are going to collapse. The exact opposite happened.
That's right.
Energy stocks dramatically underperformed under Trump. They did well under Biden. China had one of its biggest rallies during the Trump administration, and solar stocks did well. What's happened under Biden? Energy stocks have done well. Chinese stocks have collapsed. They thought he would be weak on China. He was tougher on China. Trump just wanted to do a deal with China. He said, we're going to tariff you 60%. And then he brings them to the table. They cut a deal. He wants to make money. He wants to do business. He wants to create jobs for Americans.
So the obvious quid pro quos don't always pan out. Just like under Barack Obama, the drug makers and the big pharmaceutical companies would tank. They soared under him. So it sometimes goes against pattern. How do you see it going if Donald Trump were to return?
Well, I think the Trump trade would be back. I think what we saw after he was elected, 2016, you saw small caps start to outperform. You saw industrials outperform. The market started to price in a better tax environment, which increases earnings. Look, if you move the corporate tax rate up to 28%, that's going to have an impact on earnings per share. So then if you don't get multiple expansion, you're going to have the market stalling on the basis of lower earnings. So I think that initially, the market will like the idea also of no wars. Under the Trump administration, there were no real geopolitical wars. It was relatively peaceful geopolitical environment. You don't have to worry. Right now, we've got kind of two fronts.
So they'd lose sight of some of the crazier features. In the case of Kamala Harris, they would dread some of that. But again, if she's held in check by a Republican Congress, House or Senate, it's another game, right?
Yeah, look, at the end of the day, earnings power is strong. We have projections of 15% earnings growth next year. That's likely going to come around in the ballpark, irrespective of who's elected.
Is that right?
The key is going to be the policies moving forward and then the outlook moving forward on the basis of those policies. So if you could say, if you have pro-business policies, then 2026 looks a lot better than pro-government policies. 2026 maybe starts to look a little bit worse, depending who's elected, in which case the market will begin to price that after the election. But on balance, given the seasonality of election years, as we touched on, I think a little choppiness in October, and we probably will get a year-end rally just because of the underlying strength. And more likely than not, whoever's elected, we're going to wind up with gridlock, and that's a good thing for the stock market.
We'll watch closely. Tom, great catching up with you. Thomas Hayes, following all of that. One thing we left out with Tom is real estate.
And we're back. And then I got to join Brad Smith, who I just mentioned at Yahoo. We had a great talk about Nvidia and all the other factors going into year end prior to Nvidia earnings and what we were saying might happen.
But first, the Fed's path forward here. The central bank is expected to lower interest rates in September as inflation moderates and the job market sees signs of cooling. So, how should you be positioning your portfolio ahead of rate cuts? Here to weigh in studio, we've got Tom Hayes. He is the Great Hill Capital Chairman and Managing Member here. Great to have you here with us in studio. So first and foremost, what type of pivot should investors be positioning for, especially going into this first potential cut here come September, as we're all expecting?
Well, I think, Brad, we've got some seasonality factors at play. In an election year since 1955, we generally have pretty good strength into early September, into mid-September. And then as we get closer to the election, we get a little volatility, late September, October. That happens to coincide with the first cut mid-September. And historically, the first 2-3 weeks after the first cut tends to be a little bit weaker. So you have the headwinds. So I think you dance while the music's playing right now. I think we're going to get probably some new highs we saw in the Dow yesterday. We'll see what happens with Nvidia tomorrow. Maybe the S&P and the NASDAQ will catch up a little bit. And then I think as you look at all those profits and you're smiling so wide, you could eat a banana sideways. In early September, you say, wait a second, cuts coming, election volatility's coming, and maybe harvest a few profits, have a little cash on the sidelines late October, deploy into year-end rally.
You know, it's really interesting because I hesitate to ever cast any doubt on Nvidia, especially in this day and age and in this market right now and in the performance that they've exhibited. But those Nvidia earnings are going to be out Wednesday. That report itself, if it is a dud, then what does that signal for the back half of this year?
Well, initially, because of the weight, 6%, 7%, depending on the index, initially you'll get some weakness. But what we have seen since we got some clarity that the Fed's going to be cutting is a regime change that started in July, was temporarily impaired by the yen carry trade unwind for a minute until BOJ relented and they say, wait, we'll wait to raise rates until the Fed actually starts cutting so we don't get the liquidity mismatch. So I think the focus is the shift is going to be from large caps to small caps. Large caps underperform small caps in the first 12 months after a cut by 11%. So small caps outperform by 11%. And that's also consistent with earnings growth. So this year, small caps are expected to grow earnings at 7%. Next year, 37%. And Mag 7 earnings growth decelerates from 30% this year down to 18% next year. So if Nvidia does less well than people think, I think you're going to start to see a lot of the stocks under the surface start to pick up the slack. So even if Mag 7 underperforms, you can make a tremendous amount of money under the surface.
Just to put a fine point on this as well here, I mean, the information technology sector, and according to some data from FactSet, information technology is reporting the second highest year-over-year earnings growth rate of all 11 sectors at 18.9% right now. And Nvidia is the largest contributor to year-over-year growth right now. So for investors trying to figure out whether or not, even given the run-up that we've seen in Nvidia, this is still a ripe investment opportunity, what would you say to them?
Okay, it's nuanced. I think the earnings are going to be okay tomorrow. The reason is we saw all the hyperscalers were spending like crazy. That's why their margins are going down. The magnificent margins are going down. Earnings growth is going down because they're giving all the money to Nvidia. I think there's going to come a time where investors say, where's the return on our investment? That's 2 quarters out. But right now, Nvidia is priced for perfection. $3.2 trillion valuation. Our entire GDP is $28 trillion. So you're saying it's worth 11% of our total GDP? Like, trees don't grow to the sky. It can grow a little higher, but you have to keep in mind 28 times sales is pretty rich, 37 times earnings is pretty rich. Yes, you'd say the earnings growth is 38% long-term growth, but then you look at the numbers and it just doesn't make sense because rule of 72, is it really going to double every 2 years? Sure. That would imply it's going to be half a GDP before we know it. It doesn't make a lot of sense.
All right, while we have you here, just lastly, because there are a lot of people who are trying to figure this one out, and you have some thoughts on it as well. Boeing. Boeing has a windy road of challenges that we've seen over the course of this year. The stock is down, 33% year to date? I think we have a chart we can toss up for the viewers at home. Do you see this as a buying opportunity?
I think it's phenomenal. Kelly Ortberg came from Rockwell Collins. When he got involved with Rockwell Collins, it was a $7 billion company. 6 years later, he sold it for $30 billion, 4.5 bagger. This guy knows how to run business. The second thing is he's actually an engineer. So for the first time in a while, we get to have Boeing run by an actual engineer versus a salesman, which is helpful when you want to keep doors on planes and keep fuselages together and all that stuff that's important. But the key thing is it operates in a duopoly. Okay, so at the end of the day, you can say, I don't like Boeing. They've been sloppy the last few years. Okay, well, get online at Airbus and you can wait 20 years for your next plane. They've got 6,000 plus backlog. They just said, oh, by the way, we underestimated the demand because China's flying is picking up. The middle class is growing. They're going to need another 8,000 planes. So what you like to see with stocks that have relentless, everyday bad news is that they stop going down. And that's happened to Boeing in the last few weeks. Headlines have been bad every single day, and the stock stopped going down.
NASA saying that they're going to use SpaceX.
It couldn't get any worse. You couldn't make this stuff up. Every single day they screw something up, and the stock has stopped going down, which tells you that most of the problems are in the rearview mirror. Kelly Ortberg is going to turn around this ship. The duopoly is in place. The backlog of over a decade is in place. So we like this as a high-quality business that's temporarily impaired.
Yeah, I should just clarify as well for those who are viewing as well, and the full story on the NASA's astronauts. They used Boeing and the Starliner to get them up there to the ISS, and now we're trying to get them back, and they're going to SpaceX for that. Anyway, all these things considered, still a Boeing story. Tom, you're still great. Great Hill Capital Chairman and Managing Member Tom Hayes. Great to see you.
Thanks so much. Appreciate it. And then today, I got to speak to Kelly O'Grady. My new nickname for her is Kelly O'Great, Greaty. I think she's doing a phenomenal job over at Fox Business and was happy to get on the show. We covered Nvidia after the fact and the regime change we've been consistently speaking about publicly that's starting to take shape in earnest. So we're going to listen in here.
You brought up the Blackwell chip piece because, Tom, I want to bring you in here on this, right? I know that that's something that you were watching closely to kind of get a sense of are they going to allay fears, right? CEO Jensen Huang, he said, look, we're still expecting revenue from this chip in 2024. Was it enough for you?
I don't think so. When I hear about watch parties for Nvidia, I mean, this thing was priced for perfection. It's like the inmates are running the asylum. This business is valued at $3 trillion. The entire U.S. GDP is $28 trillion. And here's what's better. Estimates of 40% long-term growth rate. That implies the business is going to double every 2 years. So in 4 years, it would be worth $12 trillion, or half of GDP. I think it's a great business. I think it's going to grow. I think there's going to be demand. I think price is what you pay, value is what you get, and 29 times sales is not interesting to me.
Yeah, no, I mean, look, I hear you. It's a great business. Susan pointed it out. If you have big tech companies saying spending, it's clearly going to keep growing. Just broadening it out, Scott, jobless claims out today, better than expected, PCE out tomorrow. The rate cut's coming. We're on Dow record watch. A lot of traders are fading this rally. Where do you stand on that?
I agree with that, and not so much fading it because, things are dire or things are bad, but I think we've certainly come so far so quickly since those lows 3 or so weeks ago. And listen, volatility is not going away. Obviously, with the election just a few months away, with the Fed in 3 weeks, and then we get the Fed again early November, volatility is there. So when you have an opportunity to buy some protection in the marketplace, with VIX now down back around 15 or so, there's no reason not to do that. So I don't know a lot of these guys back here, and I talk to them all the time throughout the day, that are shorting the market as much as they are hedging the market, because there is an opportunity to hedge the market right now.
That's a great point. It's sort of great context there, Scott. I mean, Tom, I just want to bring you in here to end. Rate cuts are coming, right? A lot of our viewers are probably sitting in money markets thinking, when do I get in? When do I take advantage of this? A lot of talk about the rotation trade. So are small caps the place to be looking at as you sort of play this out over the rest of the year?
Well, history since World War II tells us that is the play, because for the 12-month following the first rate cut, small caps outperformed large caps by 11%. And that's consistent 11%. With what we're seeing with the deceleration of earnings growth of the Magnificent Seven and the re-acceleration of the earnings growth of the Unmagnificent 493. So the top seven, they could kind of consolidate the gains that they've had, and there are going to be tremendous opportunities under the surface, including small caps, including dividend payers, including emerging markets.
And I mean, you see that trend coming in the Russell. People are excited. We will see. Gentlemen, we're going to have to leave it there. Tom, Scott, appreciate your time today.
Thank you.
Okay, look, AI.
And we're back. And just to give proper acknowledgement, want to thank Kelly O'Grady, Jake Mack, and Catherine Myers for having me on the Claim and Countdown Fox Business. Want to thank Brad Smith, Sarah Smith, and Kristen Subanos for having me on Yahoo Finance. And want to thank Neil Cavuto, Jenna DeTomasis, Kevin Fitzgerald, and Matt Hassan for having me on Cavuto on Monday. I will be on Varney tomorrow morning, Friday the 30th at 9:25 a.m. So please tune in if you're available. And moving on to the quote of the week, the intelligent investor is a realist who sells to optimists and buys from pessimists. And I think Nvidia is a good case study of this, because we're going to see in a minute that FOMO kicked in and retail buyers were buying this thing hand over fist into earnings. And you got kind of our view from Kelly O'Grady's segment on what we think about that. Let's go into some data here. And there's plenty of stuff to buy from pessimists too these days. We're going to cover two of them in our oil cans and vans stock market and sentiment results article of the week. By the way, I'll also be on, I don't know if you'll get this in time, CGTN America tonight at 8 p.m. If you want to tune into that. Initial jobless claims rising. All of this is pointing to the market is priced in about 100 basis points between now and the end of the year, back end loaded, and all this stuff matters. The focus has shifted from inflation to jobs, and the jobs report will be more important than the PCE tomorrow. The jobs report next Friday will determine whether we start with 25 or 50. I think we're going to start with 25, but we could go to 50 quick if the jobs are weak, or stay at 25 and more likely do 25, 25, 25 before the end of the year. This is all cover for the Fed. Next, Households done with deleveraging. Debt to disposable income, again, is near all-time lows, going all the way back 20 years. Debt service ratio goes back maybe 40, 50 years. So the deleveraging began when? The great financial crisis in 2009. So the consumer is in better shape than advertised, but you do have situations where the low-end consumer, $75,000 and under, is in pain. Their defaults are going up a bit, and you saw it in Dollar General today getting smashed. We're keeping an eye on that one for opportunities, but it is kind of a similar situation to Advance Auto Parts, which is also the lower-end consumer getting hit. The difference between Dollar General and Advance Auto Parts is there are 287 million vehicles that are average age 12.7 years on the road, and in order for people to drive their job, their car needs to work. So the spend at Advance Auto Parts for the lower-end customer is less discretionary than buying Mike and Ike's at Dollar General. And Advance Auto Parts is priced in the worst of the worst. Dollar General is a massive growth stock that has just begun to crack in earnest. But we'll keep an eye for possible opportunities. I think it's some time away. A number of times the word recession was mentioned in earnings calls. That's collapsed, just like you saw after the great financial crisis. And just like you saw after Nvidia, just like you saw after COVID. S&P Global UK manufacturing PMI is rocketing higher. That's what we've talked about as far as the UK recovery with GXO, et cetera. UK manufacturing PMIs, employment, same thing. Services PMI turning back up. UK firms see faster growth, cooler inflation in boon for BOE. UK consumer confidence is rocketed up since 2022. Moving on. Private clients bought REITs, financials, and tech ETFs in the last 4 weeks. They sold Japan, they sold healthcare, they sold staples. US dollar breaking below this channel. This has been core to our thesis for everything we've been talking about. What outperforms, which we actually mentioned with Kelly O'Grady on Fox Business, which was small caps, emerging markets, in our case, China, and dividend payers like the Stanley Black & Deckers of the world, and value as well. Global junk bond maturity wall records an historic decline, so everyone was worried about refinancing, and guess what? They all got refinanced, and rates are coming down. They're going to refinance again and again. 2024, already the third largest year for policy rate cuts. There have been 84 cuts so far in 2024, which means what? Which means we are going to get a reigniting of a global liquidity wave that helps groups like biotech, which have had a great run and we are enjoying, and I think it's going to continue to run for a couple more years with this just beginning. Bank of America, let's see here, 30-year fixed mortgage rates versus 10-year yields. What this is saying is that when the spread gets this wide, mortgage rates collapse. That will also be good for the Generacs of the world. It will be good for the Stanley Black & Deckers of the world, construction, etc., industrials, etc. So there's a lot to do here, and you're going to see this absolutely roll over in coming months. I think we could see a 5-handle back on the 30-year fixed rate mortgage, which I think is going to have a different effect than most people think. I think most people think that when mortgage rates drop, housing prices are going to go up. I think the opposite is true. I think when mortgage rates drop, you're going to see a massive amount of supply come onto the market for people that have been stuck and didn't want to trade out and get stuck with a 7% mortgage when they're in a 3% mortgage. It's not worth taking the double in California and moving to Texas, or the triple, or the triple in New York and moving to South Carolina or something like that. But moving from a 3% mortgage to a 5% mortgage, you're going to see a lot of baby boomers listing. You're going to see an abundance of supply, and I think that's going to help people who want to be buyers. For those sellers waiting to be a seller, you are going to be stuck in a crowd. Right now, there is no supply or limited supply. It's increasing, but you still have a little bit of power if you list. Look, I'm not a real estate agent, but I'm just telling you that maybe initially you'll get out if you're trying to sell by waiting for rates to go down, but shortly thereafter, whether it's weeks or months, all of a sudden you're going to be competing with like 100 properties in your town, and you're going to wish you sold while rates were high. Meaning we may start to see a realistic buying market in the next 6 to 12 months. Americans aren't being laid off yet, so that's positive, but obviously the Fed is, sees the writing on the wall and they want to get ahead of it, which is nice. Oversold. Dollar is the furthest below the long-term trend in 13 months. This is just getting started. So we're again, we could have counter trend moves like we talked about last week. So we're certain then jumbo cut ahead in less than 2 months. A 50 basis point cut has gone from impossible to certain. Implicit chance of at least one cut in 150 basis point cut in 2024 has gone up to over 100%. That's kind of mind-boggling when you think about it. 5-year TIPS yield has collapsed along with inflation. Dollar has collapsed. Same thing. All the things that we were planning for. Equal weighted index breaking out to new highs while the NASDAQ is showing weakness. Again, things that we've been talking about. Tomorrow's newspaper today. China 2024 industrial production year on year, 5.3%. So this is recovering. That's a good thing. In China, the industrial leads the rest. Here, Dallas manufacturing is starting to turn up. Small caps ratio relative to QQQ. This has gone up even more since this chart. Small caps starting to outperform the NASDAQ. And why is that? Because earnings are going to outperform. And in the first 12 months after the first rate cut, small caps are up on average 26.6% versus large caps, which are up 15%, 11% spread. We covered that on a couple of the shows. That's a big deal. This is from Goldman Sachs saying that their estimate of break-even rate of job creation has to be 50%. Otherwise, that's assuming 1.5 million net immigration in 2025. If you get below 150,000 new jobs created in the reports, you got a problem. Latin America earnings revision ratio is going up. They troughed in 2022. LATAM is re-accelerating dramatically. That's a good sign. Earnings growth here, Mag 7 versus Unmagnificent 493. If you look, Unmagnificent 493 started the year negative while Mag 7 was up 50%. By this quarter, Mag 7 was 29%. Unmagnificent 493 turned positive to plus 6%. And by the end of the year, we're going to be plus 16% for the Unmag and down to plus 18% for the Mag. Next year, it goes to 18% for the Mag 7, 15% for the S&P overall, including the Mag 7. Forward PE ratios, you can see small cap and mid cap are a huge bargain relative to large cap. And historically, you can see from 2010 to 2018, small cap and large cap got the premium. Small cap and mid cap got the multiple premium over large cap. That has reversed. It will mean revert. Stocks that split tend to beat the index unless Jensen Huang is selling $500 million of stocks into the hungry retail investors right after the split, and then you get a different result. And by the way, if you can't get enough of Nvidia, Jensen Huang will help you out. He's got another $80-something billion of stock that he's happy to sell as he adjusted his plan to be able to sell more to everyone who wants it. S&P 500. This is the price rate of change from sentiment trader. You only see these dramatic extremes few times in a period of years. You got it at the bottom in 19, the bottom in 20, or 18 rather, when Powell said autopilot. And then you recently got it on the yen carry trade. And now we're back off to the races, which is a positive thing. Sector composition of the S&P 500 by equity capitalization. It goes by sector. You can see that tech is now up 32%. Financials is 12%. And what he's trying to communicate here is all the times that a sector has been in a bubble is when it's over 20%. So energy in 1980 was 26% weighting. Then you had tech in 2000 was 33% weighting. Then you had financials in 2006 and 2007 was 22% weighting. So right now, if you look at what's got heavy weightings, Infotech's got 32%, and nothing else even comes close. So all the ones that are down in these low single digits, expect them to gain more share, expect tech to moderate somewhat. Evolution of equity sector composition and bubbles over time. So this just looks at it in a different way, which is the .com was 25%. Then you had housing that was in 2000, housing in 2029. China in 2007, 2008 had a 25% weighting. That was a bubble. And now these are at the exact opposite, where tech is at an extreme 33 and China is China's very low and ready for mean reversion. U.S. durable goods orders month on month shot the lights out, highest in 4 years. That is including transportation items, wink, wink. Core durable goods orders, ex-transportation, were down 0.2%. This table shows what happens to the S&P 1 week, 2 weeks, 3 weeks, 1 month, 3 months, 6 months, 1 year after the first cut. And as we've been saying, number one, election year seasonality, which we've covered, points to weaker second half of September and October, followed by a year-end rally. That's election year cyclicality. And then if you compound that with the first 3 weeks, certainly first 2 weeks show weakness on average up to the first 3 weeks after the first cut. And then as you get 3 months out, 6 months out, 1 year out, you tend to get more meaningful upside. So that's positive. S&P and first cut historically, so a little weakness and then followed by strength. That's from Renmac. Durable goods orders, you can just see here visually how dramatic that was. Orders for transportation equipment skyrocket. This is an interesting thing. Worldwide dating apps monthly active users have absolutely collapsed from 155 million in 2021 during COVID, now down to 135 million, which is pretty anemic. I guess everyone found love online during COVID. Pending sales of starter homes up double digits. Starter home inventory soars, outpacing growth in other tiers. We talked about this for many, many months. We said that the new theme was going to be not everyone needed to live in a 7,000 square foot starter home. People could actually start in 1,000 and 2,000 square feet houses like Levittown post World War II, when we had another demographic boom just like we're having now, which is going to drive the economy and equities through the end of this decade and probably into the beginning of next decade. The roaring 20s, I believe, will be a slight understatement. Mag 7's contributions to the S&P 500 EPS growth started to shrink as the other 493 came out of its earnings season. That's the name of the game. That's the core theme. If you understand that, you're going to have a very happy 24 months. Futures implied Fed terminal rate is down to 3%, which implies what? It implies mortgages with a 4 handle. It also implies 9 cuts, which would be a lot. I'm not sure if they're going to need all that, but they may very well. I could see a situation where they do 4 cuts or 3 or 4 cuts, and then you get a 3.5% inflation print, and they stop cutting, and they keep the terminal rate at 4, and they let inflation run between 3 and 4 for the next 5 years, and you're going to wake up, and whoever's president is going to say, I'm a genius, debt to GDP is only 80%, it used to be 120%, pat myself on the back, trying not to break my hand, and they'll take credit for it. But a lot more of it has to do with demographics and being in the right place at the right time. than them controlling their spending because politicians like to spend. Prime book global equities, monthly notional trading flows, so they're short out the wazoo, just like they were in the hole in 2020. So be mindful of that. Consumer confidence is turning up. Rises on views of economy and inflation up to 103.3 from 101.9. Dollar, we showed that already. Dollar to yen broke this key trend line. Expect this trend to persist. What happens after you break the trend? A lot of times you go test the line again to fake people out. And then over to Slumer at RBC. Let's take a look at the big picture here. Weekly technical chart book. That is from 2 days ago, which is about the same as right now. S&P knocking on the door, knocking on heaven's door here. I think we go to new highs before mid-September and before rolling over. I think you got to get everyone in the boat, and then you open the trap door September and October when everyone thinks everything is perfect. NASDAQ, similar thing. Maybe NASDAQ makes new highs too. I would imagine so. That is going to be a harder question because you saw today the Dow and the Russell doing really well while NASDAQ and tech and Nvidia weighing on the S&P. So we'll see. Jury's out on that. Equal weight breaking out to new highs, already knocked, and heaven's door was open at the pearly gates. S&P mid cap, same story. S&P small caps coming off the mat with that fake out with the carry trade, quote unquote unwind. I think this is going to be the story for the next 3 weeks, breaking back above here. I don't know if I doubt we get to 2,500 in the next few weeks, but maybe we do. And then during October, November, we come back and test this before a long-term upside. On to the next small cap index. We covered that. That's Toronto. Here's Tokyo. I don't see this one going to new highs. This one, I think, is going to fail. If you have been listening, and the Hang Seng, I love this. Guess what? Broke out the trend line, retested, is now breaking back up, and I think the game is just beginning. We'll cover Alibaba. Got the dual listing approved in the general meeting on the 22nd, which means that it can be included in the Southbound Stock Connect on September 9th, which will enable 180 million new buyers to buy Alibaba for the first time from mainland China. What we're seeing in terms of flows is people are raising some cash from Pinduoduo and Tencent. So my guess is some of this money is allocated to be able to purchase Alibaba for the first time, and we'll be excited to welcome those fellow co-owners for the long term very soon. And that could be, if you listened to last week with Brendan, somewhere between 20 to 40 billion dollars of buying power over time. So we're very, very excited about that. And you can see that this trend line downtrend broke, and now we did the retest, and now we're going back to the promised land. Bullish sentiment, we've covered that a million times. 10-year yield rolling over, everything we need to say. Probably see a counter trend move here, I would imagine. 10-year yield, same thing. Dollar, same thing. All the things are in place. Japanese yen, probably get a counter trend move, but that is going to strengthen over time. Canadian dollar, the loonie is getting strong, ladies and gentlemen. That is good news, not bad news. Dollar getting weak. For all of our Canadian viewers, they are smiling so wide, they could eat a banana sideways. Gold, I think this is going to prove to be a fake out over time. Copper futures, this is turning back up with China turning back up. That move is probably just getting started. And I think that's all we need to cover from this. By the way, SMH, I don't know if I have that article. Yeah, I do. It was funny. Nvidia, every time Nvidia goes down, Intel goes up, and we're going to talk about why, and that's pretty exciting as well. I could see a scenario where the SMH goes down and Intel goes up a lot, but we'll talk about that in future episodes because I want to get you out of here and get you to wherever you're going. In my case, it's called the golf course. In many of your cases, I'm sure it's called the beach. And I think that's all we need to cover. CCI, look at this beautiful breakout, back test, moving higher. It's going to keep moving higher. This thing is just getting started. We're so excited about this one. You guys hung in there while we build that base, and now we're back off to the promised land. And let's see, what else did he cover here? He covered a lot of stocks. This guy's busier than a one-arm paper hanger. All right, moving along. Let's see what else we got here. Nvidia market cap. Of course it can grow at 40%. It'll be 100% of GDP in 8 years. That makes a lot of sense. But the sell side thinks that makes sense, and that's why they're holding the bag today. All right, retail investor purchases of Nvidia before earnings. Of course, after it hits $2.5–3 trillion, everyone wants it. When it's at 500 billion and $1 trillion, no one wants it. It's just the way it goes. And they couldn't get enough Nvidia, so they had to buy a triple levered Nvidia levered right into earnings and get absolute smoke show as Jensen Huang is selling more of his stock to you. Oh, and by the way, in order to absorb all the stock that he's selling to you, he was so kind to authorize another $50 billion of buyback in order to create a market for him to sell stock on the market at 29 times sales. That makes a lot of sense. Where was the $50 billion when it was at, a $100 billion valuation? Nowhere to be found. Where's the $50 billion now? It's at a $3 trillion valuation. All right. Cumulative S&P 500 performance for September starting in 1954. So this is exactly in line with what we've been saying. Further strength, possible new highs into mid-month right before the buy the rumor, sell the news of the cut, and then some weakness into month end. Same thing with the dollar. This counter trend move that we may get here, and then weakness into September, October. Expected Fed funds, expected rate change. 200 basis points now. At the beginning, last September, it was only 33 basis points. It's amazing. Opinion follows trend, ladies and gentlemen. Initial jobless claims. This is what the Fed's worried about. This is why the Fed's taking action. We talked about the performance after the first cut. I was supposed to talk about PayPal and Disney today on Clayman, but we ran out of time. And by the way, I was on with Scott Bauer, who's a really good guy, and I like him a lot. I didn't know that he was going to be bullish Nvidia, and I was going to be bearish. So, Scott, if you're listening, no offense. It's just my view on the stock. I may be wrong, and you may be right, but always love going on with you, and didn't expect to be taking the other side of you on that one. But, all right, Disney puts Morgan Stanley James Gorman in charge of finding Bob Iger's successor. This, I believe, is the next catalyst for Disney stock, besides all the things that we've talked about in terms of the pricing, in terms of ValueAct. And the other thing that's very interesting, besides the fact that ValueAct is an activist investor in Disney, besides the fact that they turned around Salesforce, turned around New York Times, and turned around Spotify through changing their pricing packages and everything else, and completely multiplied the stock when they were involved in an activist. And they're doing that with Disney. One of their biggest successes was actually playing a role in getting the new CEO for Microsoft. His name was Satya Nadella. And Satya was a catalyst for a huge multi-bagger over many years. I believe the next catalyst for Disney, and I also believe ValueAct is going to play a significant role in addition to James Gorman, and may have actually chosen James Gorman for the job of picking the CEO. The next catalyst will be the announcement of who will succeed Bob Iger. And I can assure you, with ValueAct involved and James Gorman involved, it's going to be a big name. A name like the Chipotle guy going over to Starbucks, that type of impact. I don't know who it's going to be, but it's going to be a major, major player that everyone loves, a high-end operator that can absolutely rock it. And I think that's the next catalyst for Disney, because they've already put all the mechanisms in place in terms of the highest return on invested capital allocations to the parks and to the cruises, and then raising the prices for Disney Plus and blockbuster movies. They're hitting on all cylinders. have a couple weak quarters because the low-end customer is a little bit weak, but that will come back, and they'll have a new CEO that everyone's going to be excited about, and I can't wait to see who it's going to be. Intel hiring Morgan Stanley and other advisors for activist events. I got to say, it would not shock me to wake up one morning and see Elliott has taken a couple $1 billion position, $2 to $5 billion in Intel, trading at tangible book value, and shake the tree like nobody's business. And if that happens, this is going to be a $40 stock much faster than we expect, and then have the runway to ultimately be an $80 and $100 stock if they get the Foundry deal correct. And speaking of getting the Foundry deal correct, today there was an announcement, and this is what we've all been waiting for. Well, first off, we saw from Best Buy's shoot the lights out earnings is that they can't believe the demand for AI PCs. And who is the leader in AI PCs that is going to ship 40 million this year is Intel. And what else happened with Intel today? IBM Cloud to offer Intel's Gaudi 3 AI chips next year. What does that mean? It's half the price of the Nvidia H100. It's twice as fast, and it's 40% more energy efficient. So if you think that investors are going to stand by and allow the hyperscalers to spend unlimited amounts of money on Nvidia chips with no clear return on investment, and if you go back to the Sequoia article, the $600 billion question, given the amount that Mag 7 have spent on Nvidia chips, it would require $600 billion of new revenue that's not there to justify the spend. So they're going to want to keep investing in AI, but they're going to want to do so in a way where they can get closer to a return on investment sooner. Otherwise, shareholders are going to force them to stop. Just as I mentioned on Cavuto, if you remember when Mark Zuckerberg was spending, I think, $10 billion on the metaverse, and all of a sudden shareholders said, there's no return on this, and they sold the stock down from like $300 down to $80. All of a sudden he said, oh, did I say I was going to spend a lot on the metaverse? I was mistaken. Now the stock's at $80. I decided not to do that anymore because there's no clear return on investment. And all of a sudden the stock rebounded from 80 up to 400 or 500, wherever it is right now. I think you're going to see the same thing with hyperscalers, Google, Amazon, etc., that will either have to justify the return on investment or find new ways of doing more with less, and Intel is the way to do that, to get more for less money, and IBM is ahead of the curve on this with the Gaudi 3, twice as fast, half the money, et cetera, et cetera, et cetera. So what is that going to do? It's going to impair NVIDIA's margins, and I think this is very much like the GLP-1. Eli Lilly came out this week and said, oh, by the way, we're not going to charge you $1,000 for Zepbound. We're going to charge you $399 for Zepbound. Why? Because this little company called Hims and Hers was selling one at $200 a month that, you know, they paid a PR machine to go out and say, that's dangerous, it doesn't work, except everyone was buying it, and probably there were people getting results. And all of a sudden they said, well, just out of the kindness of our heart, we're going to drop our prices by 60% because we're such a great, beautiful company. And all of a sudden, we realize what we knew from the beginning, that GLPs are a commodity and you can get them anywhere, and it's a race for the bottom with price, and they can be life-changing. The jury's still out on that, but so far so good. It looks great. We'll see over the long term. But what we do know is it's no longer the Holy Grail because it can be replicated. And the same is going to be through the case with Intel and the GPU chips that everyone thinks only Nvidia can make, except for the fact that others are going to catch them or make something at least close enough good at such a lower price that buyers pressured by their shareholders are either going to have to stop their spend, which makes them potentially less competitive, or modify their spend so they can keep pedal to the metal for AI and AI training and data centers and all of that, but do it at a more reasonable cost, which Intel has always been a commodity producer, and will have the machinery that none of them have with foundries and be able to produce, it's going to be awesome. So I'll let you know how I really feel about it in just a minute. I'm kidding. All right. What else do we have here? The big number, 818,000 revisions. Tomorrow's newspaper today. We've been talking about that for a year. We say they've already misreported 500,000 more jobs. It turned out to be 818,000 more jobs. Hedge funds are consciously uncoupling from the Mag 7, so they're seeing the writing on the wall. You saw Druckenmiller selling out, many others. Fed's Powell declares the time has come for rate cuts. We all know that's coming. Why Disney Plus has succeeded while Netflix rivals struggle. And we know the answer to that is because they've got the best content library in the world. And I was also slated to speak about Disney, didn't get time. But the key thing there is that the parks and the experiences and the cruises and the consumer products are valued at about $80 a share. The stock's trading at 90, which implies the 153 million subscribers that, by the way, their prices went up dramatically, are worth zero. And the billion-dollar blockbusters called Deadpool and Wolverine and Inside Out 2 are worth nothing. And ESPN is worth nothing. And we're taking a wildly crazy position that they're actually worth something. And you could say, well, they have half the subscribers of Netflix. Okay, well, Netflix is worth $300 billion. So could we be worth $50 billion? Could we be worth $100 billion? Oh, and by the way, have a double in the stock in the meantime? The answer is yes. And there you go. FOMO returns to the options markets as traders chase stocks higher. Maybe we'll get some gamma squeeze into the first half of September. And we'll continue to harvest profits like we did earlier in the summer for our 2 Mag 7 holdings, which we sold off meaningfully, and our banks, which we also had big runs, we sold off. And we'll get a chance to reload some of those potentially in late October before the election when everyone's panicked, as if it's going to matter. At the end of the day, gridlock is the name of the game. And for the markets, for other things, there are things that are very important to people, and I get it. And that's not what we do at Hedge Fund Tips with Tom Hayes. We talk about business. The starter home is making a comeback as the housing market thaws for first-time buyers. We talked about that. Temu parent PDD stock suffering a record plunge after revenue misses forecasts. We've been saying for months, either unsustainable or unreliable. So far, it's only turned out to be the former, unsustainable. You can't keep selling crap at a loss and expect it to work. And we may find also, based on the FT article down the road, that the numbers were also unreliable. We have no position long or short. We just know that the competition they're referring to is Alibaba got off their ass and said, no mas, we're bigger, we're better, we're smarter, we're coming at you. And they did, and they stopped the bleeding. They are regaining share, and Temu is going to be a competitor, but they're not in the same league. And as the Chinese economy recovers and people actually buy normal stuff versus cheap stuff that goes in the garbage bin after a week, Alibaba is going to reign supreme. Tool up for lower rates with Stanley Black & Decker. This is a huge article from the Wall Street Journal. This thing, I mean, we've had a big move in it, but it's just getting started. And we're excited to see all these theses continually play out one by one. Fed cut could lift Chinese stocks. Here's who could benefit. We know who could benefit. This, I'll continue to remind my wealthy investor friends who are listening. There are opportunities in beaten down office buildings, and in this article, and Barron's, they're talking about certain REITs and so on. But you all know what I'm talking about, and you're probably ahead of the pack on that. The key is just holding period and burn until it turns. And what's going to cause it to turn is a higher unemployment rate, where people get scared and they want face time. They go back to the office. But more important than that, every boss knows they get twice the productivity from people when they come to the office, and the collaboration and the magic that comes from 1 + 1 is 3, but they don't have any leverage to force people back to the office when the labor market is still tight. That is changing. Once it does, they'll just say, you don't want to come to the office? Mail in your security pass and let's call it a day. And that's going to be happening more and more and more. And that's where office buildings are going to fly. Met a person when I was out to dinner the other night, and she was saying she's doing leases at like 140 a foot in New York for A properties. B and C are still spotty, but like it's hotter than ever. So there you go. And Boeing says a travel boom in China will double demand for planes. Yeah, so basically Boeing was saying, yeah, you know how we said we had 10 years of backlog with 6,600 planes? Yeah, we messed that up too. It's actually another 8,000 planes that we don't think we're going to be able to provide because we don't have enough capacity. In other words, we have more people throwing money at us than we'll ever be able to possibly handle, and you can't give the stock away. And those are the things we like, the common sense things, the cigar butts that are sitting down there, and before long, it's a double, and everyone says, oh, how can I get call option, daily and weekly call options on Boeing when it's at $400 and it'll be sold to them. The dumb money poured into Nvidia ahead of its results. It could have been worse. So that's from Steve Goldstein over at MarketWatch. Canada Goose, known for heavyweight parkas, leans into t-shirts and shorts. We'll see. We'll see. We're going to cover this one maybe in detail next week. Obviously, their APAC is shooting the lights out. I think that's going to continue to even grow further. China vows to quicken buying unsold homes for public housing. So again, they continue to make these incremental moves, so that's good. Nvidia tumbles after disappointing forecast. Blackwell chip snags. The Gaudi 3 is working just fine. Here was an analyst saying that Nugent said rivals such as Intel could quote unquote chip away at Nvidia's market share if they developed a better product, which they have with Gaudi 3, certainly over the H100, not quite at Blackwell levels yet, but you know, Blackwell's delayed. That's going to give Intel some time, but twice the speed, half the price, 40% more energy efficient. Energy is a huge input cost for the whole training game for AI, so that's that. But IBM going with Intel here, this is a big deal, ladies and gentlemen, because if you remember, IBM is the OG of Intel. You remember AI, if you remember Watson and Jeopardy and all that stuff. So they know a thing or two about training models. Alibaba, Tencent cast wide net for AI upstarts. Since 2023, 40% of Alibaba's deals in China and 30% of Tencent's have targeted AI startups. I think we're going to find out somewhere 12, 24, 36 months down the road that a lot of our gains were attributable to something that we didn't even know, something they owned wound up being a 1,000-bagger, and we had 10% of the company through our ownership in Alibaba because they give them cloud computing credits in exchange for equity, which is a brilliant deal. Alibaba shareholders approved dual primary listing, paving the way for September southbound inclusion. We talked about that. That's a big deal. Pinduoduo suffers a $55 billion market cap wipeout after flagging uncertain market. And the comedy of this is that Intel, Pinduoduo, I think, sold off 30-something%, and Intel was, Baba was down like 4% on that day, thinking, oh, the Chinese consumer is weak. That's not the reason Temu was down. The reason Temu was down is because Alibaba said no mas and took the share back, started taking share back, and they can't compete with them because they're bigger, they're stronger, they're meaner, and now that they're focused, they're going to destroy them. So other than that, how was the play, Mrs. Lincoln? So let's get down to our article of the week. Oil cans and vans, stock market and sentiment results. Let's see where we are on time. We got to get you guys to the beach. We covered all that. All right, I will go through the key points for the Advanced Auto Parts update. So, key points for the continued turnaround. Number one, solvency risk is off the table. They sold the $1.5 billion Worldpac business. They'll get $1.2 billion net, and they will use that to bring down the debt ratio to 2.5 times and reignite growth by opening 100 stores per year. They've got a new real estate team. So this is not just a stay alive story. This is a growth story. A stay alive story makes it a double over the next 3 to 5 years, which they just guaranteed with that sale and paying down the debt. A growth story of opening another 100 stores a year and shutting the ones that are cash flow negative, which is accretive to free cash flow, is the story that we want to hear. which is what this guy is doing, who ran Shane O'Kelly, who ran HD Supply, $7 billion business for Home Depot. He knows how to run this type of business, and he's taken the steps to move it, and it's going to happen over time. Yes, the 75,000 and under is weak. Yes, it's weak, but they were still able to increase comp store sales by 0.4% year over year, despite the challenged low-end customer. Also, they had a ton of stuff that was just mispriced relative to the competition. Now, they're not racing to the bottom, but what they are doing is matching their competitors at the prices where they are, so they've got an equal shot to get the business. And he tells a story about a radiator that was like $50 more than any of his competitors, and he was wondering why they weren't selling radiators. Well, duh, you got to be in line with the market. And they've done that now across the board, so they're getting products to people quick. And the most important thing that they're doing that their competitors have been less good at doing is paying up for their frontline people in order to have people that can talk to the professionals. Remember, it's a blended box. Half of it's from the do-it-yourselfers walking in to buy a battery and putting it in the parking lot. And the other half is the professionals down the street with their garage need a part right away because they got to get the car off the lift or they lose money by tying up the bay. So Advance needs to know what the parts are, get them the parts quickly at a reasonable competitive price. And that's what they're now doing. And they're the only ones that have these specialized frontline people who actually have experience in the business versus hiring someone who worked at Carl's Jr. the week before, who knows about lettuce wraps but doesn't know anything about, alternators and sounds like an idiot when the professionals call. So I think over time they're going to build that goodwill with the professionals and be the go-to place in selected regions that they dominate. The other thing that they're trying to do is they're going to shut down areas that they're not the leader, and they're going to reinvest around areas where they are so they can keep the growth and keep every store growing free cash flow, which is the name of the game. This guy knows his stuff. The distribution center consolidation down to 14 from 38, and they'll have these nodes and hubs all over the country. That's going to lead to at least $50 million of procurement savings next year. And then finally, he talked to achieving $100 million of free cash flow this year. This is what we talk about every single company. All we need to know is that solvency risk is off the table, and they've got some level of, they're getting to cash flow positive or even generating free cash flow. And then if it's priced in for death and it doesn't die, that's when you get doubles and triples. And that's going to be the case here, just as it was with Cooper Standard. And then once they get going, they take on a life of their own, and that's when you get multi-baggers. And by the way, while we're on to it, go to hedgefundtips.com, click on terms. This is all opinion, not advice. Speak to your financial advisor, et cetera, et cetera, et cetera. We deal exclusively with accredited investors, qualified clients, family offices, et cetera. And so you can go through these 30 pages of stuff that I outlined one-on-one. This is how you become a good investor. So most of you are going to blow through this and just take those 8 points and run with it, and that's perfectly fine. But those of you who are serious about honing your craft, when you read thousands of these over a career and you pay attention to every single word, you start to, large language model, develop inputs where 3 years down the road, you're going to see a different company and a certain series of actions, and you're going to say, I'm going to make a fortune on this because this is what I saw happen in the past, and this is what happens when this A equals B equals C equals D. But you can only do that from doing the work consistently over a long period of time. There's no quick fix. And if you get a quick double or triple and you haven't done any of the work, you'll give it back to the casino because you don't know how you got there. All right, so you can see we did a ton of work on this. But let's go on to VF Corp. So we did oil cans. Now let's do vans. The key points for a continued turnaround. Free cash flow plus proceeds from non-core physical asset sales is $600 million for this year. That's excluding the $1.5 billion Supreme sale. They brought their debt down $587 million so far this year. North Face had a direct-to-consumer up 6%. Their U.S. wholesale was the weak point. They got $1.5 billion. So again, These are key things we've been saying were going to come, are now happening with Advance Auto Parts getting rid of Worldpac, deleveraging the balance sheet, getting back to growth, 100 stores a year. VF Corp taking solvency risk off the table, selling the Supreme, getting a decent price, paying down debt, putting some into the business for growth, on track for $300 million of cost cuts on top of it. Vans, quote, while the headline numbers remain weak, several indicators are showing we're headed in the right direction. EMEA is once again the region which is showing clear, early, encouraging signs with wholesale up in the quarter for the first time in 6 quarters, with particularly positive momentum in key accounts. And he said last quarter that EU was kind of the canary in the coal mine. When that starts to turn, it's the beginning of the entire world turning, and he reemphasized that on this quarter's call. Vans, quote, our new products which are performing well across regions. The new school continued to gain momentum and is performing well across regions and is now the #2 franchise globally. It's exactly what the guy in the store, the skater dude who puts the skateboards together, was telling me. I spent an hour and a half talking to him about every single shoe and traffic and where people are coming from and what are the age of people and what are they excited about and why do they buy and all the other things that you would do in a channel check. Next, new products and marketing efforts are resonating with consumers and contributing to further progress in Google search trends, which continue to move in the right direction across our markets. 9, North Face, quote, across both channels and regionally, the standout continues to be APAC, which grew strongly, up 35%, even as we comped the post-COVID opening quarter last year. That's China, ladies and gentlemen, where the consumer is quote unquote dead, but has more cash than ever. They will thaw. They will get excited again when all their friends start to have new clothes. They will too. Quote, at Vans, we still see modest sequential improvement as we did this quarter moving forward. So each quarter, look, it's not exciting to be down so much and say, wow, we're doing great. We're down less this quarter than we were last quarter. It's like, take them around back and shoot them already. But it's a turnaround process. We knew exactly what the plan was. And as despondent as some of the numbers look when they're saying them, that was all part of the plan. So don't shoot him just yet. He's doing a great job. The new platform in the Americas adopted from Europe, this was another key part of the plan, is moving strongly in the right direction. And at Vans, we're seeing the progress we're expected. Next, Vans. The new franchises are doing well, and we've got 2 of our new franchises that are now in the top 5. So Ultra Range and New School, one's #2 and one's #5. Vans, quote, our grassroots campaign is well underway, as is our influencer campaign. You may have seen a few celebrities caught wearing Vans just recently. If you Google it, you'll see it. We covered it last week. I think it was Jennifer Lawrence and 2 other young it girls that I have no idea who they are. I'll ask my daughters. VFC, quote, Emily Ratajkowski was one. I know who she is. And then I forget the other one. Quote, something that some of you may not have realized, we are moving super fast here. And a lot of what we're doing, for example, right now, I can't tell you what we're doing, but we're doing a lot right now that we're not disclosing. For example, at this point last quarter, we didn't tell you about Sun. That's the lady that's going to run Vans that came from Lulu. You didn't know about Carolyn, who's running North Face. You didn't know about Supreme, which they got $1.5 billion. And I'm not suggesting we've got people changes or portfolio changing. My point is we just got big activities that are happening all the time now, and the pace is not going to let up. This guy, this is his last run. This is his Jerry Seinfeld go at the top, go out at the top. Bracken Darrell is a winner, and he's going to turn this thing, and it's going to be a multi-bagger, and everyone's going to look back at, actually, it's funny. No one's going to look back and say, wow, that was such a great call. You only hear when it's not working. You never hear when people cash in for a 5-bagger and they're like, wow, that was unbelievable. You never get that call. It's always like, when is this one going to work? It's like unbelievable. The gift that never gives. All right. Van's plan, quote, so what are we doing? We're innovating, and we're also putting in franchise management. So innovating by bringing out new styles. So you've seen you're starting to see them come out one at a time now. AV 2.0, that's what the skater guy was talking to me about on Fifth Avenue. The new school, 3 new styles this quarter, and we'll have more coming, and then some really key collaborations to give energy. And then franchise management. When you're going to see us take the gas out of some of the older styles for a while and then re-goose them when we first, at the very top of the culture chain with key influencers, and then flow them down. So what are they doing? Everyone and their mother bought Vans 3 years ago. They got every color of checkerboard slip-ons in their closet because it was hot, it was trendy, and that's what Vans does since the 1950s, is it runs in cycles. And so they're not going to jam something that people have in their closet. What are they doing? They're coming out with brand new stuff to get people excited about the Vans brand, like they're doing with New School, like they're doing with AV 2.0, like they're doing with the Ultra Long or whatever that's called. Maybe I got the wrong ones, the Lowlands, which I think are cool as hell. And so they keep putting these out, and then once they hit peak excitement and everyone wants Vans, then they're going to flow through the classic stuff that goes bananas, and you're going to see revenues just hockey stick like nobody's business. But they're creating the buzz, they're laying the foundation, and then they're going to jam the channels, but they're not going to do that right now. So they're going to degas it and then re-goose it. And look, I've never run a footwear company, but I'll tell you what, I like hearing that he has a plan and he knows exactly how this is going to go, just like he said what was going to happen with Europe, just like he said what was going to happen by bringing the platform over, just like he said he was going to sell a key part of the portfolio to delever the balance sheet and invest in growth, just like he said, ... Both Shane O'Kelly and Bracken Darrell bet on the jockey. They're doing exactly what they said. It's just the day traders and the emotional morons that it doesn't go fast enough lose out the opportunity. So we'll sell a piece of our stock to them at $50, and we'll sell some more to them at $80, and we'll give them as much as they want at $100 and sold to you, and it'll go up to 110, and they'll hold it to 50 because they're so excited about the story at 110. Just like everyone's so excited about $3 trillion Nvidia that's going to grow at 40% a year. Just do some math, ladies and gentlemen. Rule of 72. 72 divided by 40, which means the company is going to double every 1.75 years. So in 3.5 years, the company will go from 3 trillion to 6 trillion to 12 trillion, 50% of GDP in 3.5 years based on current sell side estimates for long-term growth. You can't make this stuff up. And when I said to Kelly, it's like the inmates are running the asylum, welcome to Crazy Town. I mean, you literally can't make this stuff up. Like, how people sync that math is beyond me. So leaving that aside, unless we can start eating GPUs and building houses with GPUs, I think the probability is low. So gross margin, quote, we do expect gross margin to improve throughout the year. So that's all good. There are a million things here you can go through. We are going to get you to the beach. We're already an hour and change in, and we got to get to fear and greed is still neutral. That's a good thing if we expect a couple more weeks of strength. Earnings came in a little bit, but this doesn't account for weightings of stocks, but just in aggregate, Dow down 1.92 for this year, 1.21 for next year. Is probably skewed into one stock. You can look at it on the website. NASDAQ came down a bunch more. This has to be one company, 7.676, which is why we've been saying Mag 7 decelerating, unmag 493, accelerating. Where do you want to put your money? Unmag 493, dividend pay to small caps, emerging markets, i.e. China. Be interested to see which company is responsible for a lot of this. He did the numbers wrong here. All right, well, all right, we'll get this redone and we'll get it posted. This is getting deleted. All right, moving on. Economic data. Durable goods orders, this shot the lights out. That's a good sign. Retail sales had been good. That's not this week. I'm talking about last week. So it's confirmatory that there's still some strength there. Atlanta GDP now at 2%. Initial jobless claims today were in line with expectations, but still with a 2 handle. So that's, that's what's got the Fed in action here. 231 versus 233 last print. PCE prices came down. Tomorrow we're going to see PCE, which people think is important. I think it's less important than the jobs report at this point. Let's move on to the Ask Me Anything questions. So for those of you who don't like Ask Me Anything questions, thank you for tuning in. We'll be back next week. For those of you who do like Ask Me Anything questions, here we go, and thanks for submitting them. Okay, number 1. John Manza, why is GXO appearing to dilute shareholders as shelf offering? Number 1, you do a shelf offering proactively. So if they have, if I'm a CEO and I expect really good things to happen in a reasonable amount of time, I want a shelf offering in place, because if I get to some ridiculous valuation before the fundamentals support it, I want to be able to say sold to you. In the shelf offering that I viewed, there was no clarity around size or price or anything. I think they just did it as kind of like you buy insurance in the future, or they could be doing a shelf offering if they have to, if they want to buy a company and use stock to do it as well. So it's unclear whether at all any dilution is going to be the case. I'm not worried about those guys because they have decades worth of history in creating shareholder wealth, not destroying it, not doing dumb deals, not diluting shareholders, and this time will be no different. Moving on. Ite Naman, loyal listener. Yes, Ite, I know you've been with us for a long time. Excited to see a Fed cut soon. Positive GDP growth, stock connect, weakening dollar coming together all at once. Would love to ticker on ZOOMD. All right, let's see what this is. I wonder if he's referring to regular Zoom. No, ZOOMD. This is a tiny trading vehicle. We would never put clients in something like this, but I'll take a quick look at it. ZOOMD. Oh, it's a Canadian company. All right, cash flow, revenues are rolling over. Free cash flow's gone up a little bit. Gross margins are up. This is a strange company. What are these guys doing? Marketing, technology, user acquisition, engagement platforms worldwide. That's more ambiguous than anything I've ever heard in my life. Operates a mobile app user acquisition platform that integrates with various digital media outlets. Unified view of various media sources, comprehensive. The only word they don't have in here is AI. I mean, this sounds like a big promote. So if you want to play the I'll be smarter than the suckers game, have at it. For me, I don't know. I see declining revenues. I'm sure they have a decent balance sheet. $4 million of cash. 0 debt. Cash flow from operations is spotty, but I think they're free cash flow positive. Yes. I have to see the composition of that. This is a $3 million company. I mean, I can't really say anything about this. Yeah, it's not for me. It doesn't mean it's not going to work. I mean, I'd have to do 10 hours of work on this for me to even look at it, and I'm not able to do that. So for me, it's a pass. Doesn't mean it won't work. Philippe Andrew Pincos. Hey, Tom, thank you for the invaluable insights you provide. You've unknowingly become a significant mentor to me. What are your thoughts on Dollar General and Dollar Tree? I'm curious about your entry point for Dollar General. I appreciate. Okay, I'll tell you my exact entry point before I do it now. we're not close to doing anything with this, but we are paying attention to it. So the answer is not yet, and more likely than not ever. But you know, 50, 60 bucks, I would start to do real work on it. But for now, this is a broken growth stock, and these things take forever. I'll probably be buying it in 1.5 to 2 years, a lot lower. Although Dollar Tree looks better. I mean, in fairness, Dollar General could snap back, but let me just take a look at the fundamentals. I mean, I think their comp store sales were up 1.4%. I had a busy day today, so I didn't get to dig into that one, but let's see. So they started recovering free cash flow revenues, so they must have said something really bad. I'm going to spend some time on this week because this is my knitting, but I really don't think I would love to see it puke for another couple days down to like a 6 handle. I mean, at 60 bucks, even if I buy it at that price and I have to wait 3 years for it to build a base, or 2 years like we did with Baba, and then it goes back to, you know, 150 or something like that, then that's a good IRR. But I think you're going to have plenty of time to buy it. And my guess is they're going to be in the store closing business because this is discretionary versus necessity. Like Advanced Auto Parts is, you know, going to Advanced Auto Parts, you know, they don't have Advanced Auto Parts at the local mall because you want to browse like you do for Lululemon or Apple Watches. You go to Advanced Auto Parts because your car's not working and you need to get to work. So that's why we like that part of the turnaround story, even though the weekend of the customer is weak. But this could get cheap enough quickly that we would just definitely take a flyer. We're just not close to those levels right now. And we'll probably have to do an analysis between them and Dollar Tree and Five Below and all those guys, and see which is that got in this pole position. Because when a sector is dislocated meaningfully, we like to buy the highest quality in the most dislocated, kind of like 2022 when we were buying Banks and Energy, we bought Exxon and we bought Wells Fargo. In China, highest quality, we buy Alibaba. And when that sector starts to recover, they're going to do fantastic. And I think it's going to be sooner than everyone expects. But Philippe, you are right on, and you're early. Will E, do you think Advanced Auto Parts can reach a similar evaluation AutoZone? No, I don't. I think Advanced Auto can be a pretty easy double over the next few years, and more likely, you know, even a triple if this guy really runs it right. But AutoZone is a much bigger business, and there's no way this thing is going to be 40 bagger. You know, let's just put that to rest. I mean, I like your optimism, Will, but it's got a lot of lifting to do. We're looking for a double or triple in a reasonable amount of time, and then we'll look at the financials then, and we'll look at the things. Maybe we get a 4 or 5 bagger if we're lucky, but I don't think we get from you know, just to pull these two together quickly here. I think you got Advance, which is, you know, a $2.7 billion business, and you have AutoZone, which is like 20 times that, $54 billion business. I don't think it's going to get to a $54 billion business. I definitely think it's getting back. I think it's getting easily, not easily, but I think it's getting to a $10 billion business for sure. I think they can do that if they do it well, and we'll be perfectly happy with that. And then when everyone says it's going to be the next AutoZone, we will be saying, sold to you. Ung said, just made a statement to thank me for everything. Thank you for listening, Ung N. Again, just a reminder for all these people that applied for the video job, a gig, and didn't get it, video editor. I do need an admin for all those posts that we talked about early on. If you applied for the video job and you want the admin job, you will have greater weighting than all the other people applying for the admin job. All right, Carrie Jessen, I'd be interested in you on Foot Locker. You often talk about the jockey, and Matt Dillon, the new CEO, came from Ulta Beauty with 16% CAGR. Seems to be doing a lot of great things, and they have this quarter return to growth and expecting 8% EBIT margin in a couple of years. Oh, this is interesting. Wow, good work, Care. Kaare says, by the way, their CCO name is Frank Bracken, and mentioned on this quarter's call that, quote, and while the vulcanized footwear category remains challenged overall, we're seeing encouraging trends out of the Vans brand, especially through their new school franchise. So there you go. Foot Locker. Let's take a look. At some point, I don't want so many retailers. Having Advanced Auto Parts is enough. This is also turned a lot off the bottom, so I kind of missed the boat on this. So I'll take a quick look. But for me, I wouldn't put this in my portfolio. If you're just looking discreetly at this without the context of a portfolio, yes, they are turning. That's why the stock's doubled. Revenues are still weak. Gross margins are still declining. Let's see, free cash flow. Oh, just turned up. Yeah, I just don't think there's enough upside relative to the risk. It's still going to be a low quality business that's going to be cyclical, so you'll probably catch the next cycle, but you already missed half the move. Even if it goes to 60, you have a double. I mean, from 14 to 16 is a four-bagger. I just, not for me. No, I don't like it, but I like the fact that you own VF with us, and I think you're going to do just fine there over time. Eric Albright, if you had no Alibaba exposure, would you consider taking a punt on PDD? Hell no. Unreliable or unsustainable. Also, given the risk of poorly reported numbers, what are your best resources, tips on learning how to decode suspicious financials? There are books on that. God, I read them all probably when I was your age. Google books on accounting irregularities. I would say this: stay out of Chinese stocks, except for the biggest and the best. That'll save 90% of your problems with accounting fraud. And other than that, if it looks too good to be true, you better do your work and you better do your channels checks. But there are techniques for it if that's the game that you want to play, and there are several books. Maybe I'll post them on the website or something when I think of it. All right. AMA. Okay. This is from Bob Geisman. Thank you for your time and education you give every week, with lots of other fund managers and analysts predicting the dollar's loss of fiat currency status. What, in your view, happens if and when this takes place? Bob Geisman. It's not going to happen. You'll consistently be able to get less for the same dollar over time. I guarantee you that, but you're not going to lose it. And everyone else that's telling you you are, they're either selling Bitcoin, gold, or books. And the only one that's going to benefit from taking that framework is the one selling you those things. So I would just pass on that flawed framework. That is just not going to happen. All right. Let's see here. Matt Hiller says, I was wondering why Alibaba is down 4% when PDD is having bad earnings. I just said why, because they thought it was related to the Chinese consumer. What it's related to is Alibaba is back to ass kicking. And Ronald, I'll call you about what you had inquired about. Here's from Adam Hawk. Thanks for your question. AAP, number one, CEO targeted operating margin mid-single digits as opposed to competitors AZO, O'Reilly. Why is he aiming so low? Because it's been mismanaged for 5 years plus. Is there a fundamental reason for it? They're probably lower end in terms of the consumers, and it's going to take some time to turn that around. Customers complaining about price not being competitive, so they're not in line. And he says, so they sell at higher prices only to produce less profits. Yes, because people don't buy at higher prices and they hadn't done the proper analysis. Worldpac sale, new CEO, and third point pushing, but is that enough? Maybe not for you. It's plenty for me because I've done the work. So I'd suggest go through the article of the week, or even more importantly, go through the source materials. You listen to the call. You read the transcript. You determine what's important. You go through the last 12 calls. You go through the last public 3 years of annual reports, and then you'll determine whether it's worth your dollar of investment. That's where you win, is when you go through the work. What I try to do here is share 10% of my framework to what I do to get you started on the right path. But ultimately, you just have to put in the legwork and the time. It's like golf. You know, you can read the best book on golf. If you don't play 2 times a week or practice 2-3 times a week, you are not getting to a single digit handicap. By the way, I got my swing back just in time for my chipping to go to shit, but it's all going to come together. I will find a way to get to where my goal by the end of the year, even if I'm playing in a snow hat and gloves. Appreciate your input. Doing my best to share your content in Israel. All right, thank you, Adam. I'm very grateful for my Israeli viewers and listeners, and hope everyone is doing the best they can over there right now. Okay, Sagar, been a loyal listener to your podcast 2 years, love your content. Oh, no, okay, yeah. So have her apply for the, all right, never mind. James Runyon. Okay, that's for the video. Brett, what are your thoughts on Top Golf Callaway, MODG? Disaster. They're struggling with the, they've got a good driver paradigm. Other than that, from what I understand, I don't play Callaway, but they're getting hit on the Top Golf piece and shutting a lot down. This has always been a garbage business. The ticker used to be ELY. I would never buy this business. It's a terrible business. So even though the demographics should be favorable, see, I still type in ELY, MODG. Call me if it gets, well, it's already getting below 10. I was going to say, call me if it gets below 10. It's already there. I won't buy this business. This is a trading vehicle. So if it gets back down to like 7.5 or 5, buy it and just sit on it and sell it when it gets back up to 20. I don't, their margins continue to deteriorate. This is a garbage business. Don't go into the golf equipment business if you can avoid it. That's it. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Have a great, long, exciting holiday weekend.